If you're a mortgage broker, here's a simple truth experiment. What would your month look like if you could spend $7,370 into ad spend and pull out $46,000 in commission in 1 month? That's exactly what Mike, a loan originator from Florida, did with our deal flow system. Okay? So in this video, I'm going to show you how he did it. The system, the funnel, the economics behind the 11 funded loans is 6.24% return on ad spend and 0 shared leads. Let's start with where he was before we stepped in. When I met Mike, he was writing a $4,000 check to Zillow every single month. That's $48,000 a year just get thrown into the pit with 7 or 8 other lenders on every lead. 84% of those leads has been already sold to someone else. So he was chasing people who are getting hammered by calls and SMS, emails all day. So his contact rate, 22%. That's not good. That's not good. And his funded conversion, 1.5%. It's like 1.5%. It's really, really low. And on top of that, the docs were messed because they had the bad intake. So his processor was wasting time each pre-screening people who were never going to qualify anyway. So the conclusion was pretty obvious. Mike wasn't the problem. The input was the problem. Most brokers think they have a lead problem. They had the filtration problem. Mike didn't have the lead problem. The problem was anyone could opt in for the mortgage. There was zero intent in the financial readiness. The borrower's entire ticket and the serious borrower landed in the exact same bucket. FHA, VA, DSCR, conventional, all those loans routed to the same way. And there was no commitment before the call. They feel like, and there was no commitment before the call. If they felt like showing up, great. If not, Mike just lost the hours of work. So the lead volume was never the issue. Anyone in this market can generate leads. The borrower selection was, the filtration was, the pre-screening was. So we attacked that first. Before we touch an ad account, we did what I called phase 0. Actually understanding his market. We mapped the lender across all Florida. We calculated, and when we look at the LTV of the neighborhoods, bands, credit score, distribution, everything, and what is the mix of the transaction he had, what should we do for him. We estimated what people in Florida optimize for. Rate versus APR. How long it took them from clicks to the close. And in this case, it's about 12 to 27 days. And how sensitive they were to refinance or tapping the equity. My point is, nothing we built for Mike was copy-paste. The system was built for his market, not from a template. New client acquisition machine. Out of all those data, it came a simple acquisition machine with 5 moving parts. Targeted ads, AI pre-qualifier, loan routing, self-book calendar, and funded loan. And that was the 5 simple steps. The strategy was straightforward. Filter before contact, eliminate the manual pre-screening, and get borrower commit before they ever see my face. So that was the strategy. So I would call this step as the gate, the filter. Think of AI pre-qualify and pre-screen everything like a bouncer. Before anyone hits the mice calendar, they answer 10 key questions. The exact credit score, real income, gross and net income, current debt, I don't know, the minimum payments, employment type, if they are W2 salary, self-employed or 1099, whatever it is. Residency status, bankruptcy history. So if they won't answer those questions, they don't get a call. That's a pre-call friction. It's what gives Mike's a post-call clarity. Once they are through the gate, we don't send them all down one generic funnel. We separate them. FHA borrowers goes to the FHA funnel. VA borrowers go into the VA lane. DSCR, just all those investors go to the DSCR. We got the separate lane for the conventional HELOC, band segment, and all the rest of the application. And each lane, it has the own script, own ads. It does have own follow-up system because it does have the own underwriting logic, and it has the own scheduling rules. One funnel for everyone is how you get a chaos. One funnel per borrower type is how you get the control, because you understand in which channel you get more leads and how you can get more qualified leads per each channel. and what is the cost per funded transaction in each channel. Creative also refused to run a classic get a code or get a pre-approval, that because it just dragged all those rate shoppers into the funnel. Instead, every ad promised a specific solution for a specific borrower and routed into his own funnel. For example, denied by bank, 47 alternative lenders might say yes. This is the specific ad route to the bank statement kind of loan. And DSCR loan, the property qualifies, not you. So that's routes to the DSCR investor funnel. So any specific, all those ads, they have a specific funnel because they are separate. The effect is simple. Higher clickers scroll past and the serious borrowers raise their hands. Simple, because we built the offer for them. Here's the what number in the first month. 121 application, 57 pre-qualified self-scheduled appointments, and 34% show up to the appointments. It's ended up with 11 loans. Do you remember the numbers from the first or second slide? So right now we do have 47% qualified calls, and actually it was 61% show up rate and 32% close rate, and it's almost 10% funded loan. So it means if you have 100 qualified, you get 10 closed transactions. As simple as this. You might get more because you might have better connection with the lenders, wholesaler, whatever it is, so you can close more transactions. And remember, Mike is just doing his job, having conversation, structuring loans. The system is doing the heavy lifting. So let's talk money. In those 31 days, Mike spent $7,370 on ads, and those 11 funded loans cost him $671 actually to acquire each. Before this, his cost per funded loan was roughly $2,600 something, and right now it's $671. And his average commission per funded loan, that's a roughly number what I have. It might be higher, it might be lower, but it's just $4,182. So we cannot do anything about the average commission, but the point is the total commission in 1 month, it comes from 11 loans, and it's $46,000 approximately. It might be higher, I don't know. I didn't ask correctly, you know what I mean? Because there is no mortgage broker disclose this to you. So the thing is, that's 6.24% return on ad spend. So you know that how much you can get out if you have this number. And the sexy part of the first month is the real power is what it's under the hood. The real reason it kept working is there's two systems running 24/7. 48 weeks nurture engine and automation layer. Automation layer that keeps Mike's life easier. Calendar sync across the loan programs, text and email reminders before calls, document verification before the consultation, call prep in his inbox, and auto routing every lead to the right lane with the real-time tagging. That's super important. And the net result is his show-up rate climbed another 18 to 31% from the number they have. So that's so important. So you are having the engine that it's just take you to understand how much is the cost per funded loan for you. So for example, let's say 700 and you want to close 20 transactions, you know that how much you need to put into the ads to close that 20 transactions. So that's the beauty of this engine and this system. So why this is outperform the traditional lead gen? Shared leads with the 7 other lenders and competitors versus exclusive filtered leads. No pre-qualification system, no pre-screening system versus AI pre-qualification and pre-screening system. Generic drip campaign like the email, text messages versus loan specific sequence, email, text message, WhatsApp message, and the iMessage, the blue message. Manual lead scoring versus automatic AI-based routing, basically based off the score and the information we get from the leads. Low show-up rate versus double-digit lift show-up rate. Wasted processor time versus borrowers who are ready to close. And that's why the economics flip so hard for Mike. It can flip for you as well, trust me. If you're watching this and thinking, I want my version of that, here's how we work. We start with 30-minute call. On that call, we map your zip code, your loan types, your lender list, and your volume goals. And then we set the realistic outcomes before we ever launch anything. And if that's a fit, we build a system like Mike for your market, not a template on your market. If you want to see what your number could look like, go to the revenuerunners.io, book an appointment. We have there should be a button to just book an appointment and just book a call with us. It's gonna be me or our team members. So let me wrap up the video. So the result depends on a lot of stuff. So the result of Mike, it was based on his connection with the lender and borrower profile and the execution. And we cannot mention the Mike's full name because of the law privacy. But if you think this is not the exact case study, you can DM me and I can share with you live on the call. And right now we have this system deployed across more than 412 brokers on over $863 million funded loan, and we manage almost 5 million assets. So if you're a serious broker who wants to predictable way to turn ad dollar into the funded deals like Mike did, go to revenuerunners.io and book a call. I'll see you there.